Let's start off talking a little bit about valuations here. I mean, yesterday seemed to be kind of the first day in a long time that we had, I guess, a quote-unquote valuation scare when Apple sort of provided that sales warning. And today, it's like that never happened. Do we need to be concerned at all right now about how the market has been behaving, equity markets, I should say, and whether valuations have gotten a little bit too far ahead of themselves?
I think with respect to valuation, it's definitely an important question to ask. But when you look at equities, you're really looking at equities relative to other asset classes. And given the equity risk premium, which is still quite wide relative to bonds and even corporate credit yields, I think equities still offer value in the market in a marketplace right now where valuations are relatively stretched across the board. And so I think you have to think about equities in context of other asset classes. And to us, there still is value in equities. Now, I don't expect that you're going to see significant multiple expansion from here, but I do think that earnings price appreciation will follow earnings growth, price appreciation in the S&P 500 and in stocks more broadly will follow earnings growth. And we do have an optimistic outlook for the trajectory of earnings this year.
Erin, why do you think it is that the market is just so willing to look past the coronavirus concerns when it comes to risk assets? Apple fell yesterday, already back. Overall, you have a few hiccups here and there, and then the markets just ignore it. Meanwhile, this is a very uncertain thing, and we're talking about a major shutdown of the world's second biggest economy and the source of just so much key supply chain manufacturing infrastructure.
I think that the market's gotten really accustomed over the last decade in dealing with uncertainty. And it's really is able to look through in terms of the resiliency of the underlying macro factors that are driving the economy and ultimately driving earnings growth. And when you look at the underlying drivers right now, you have very strong corporate balance sheets, low public sector leverage, high savings rates across the globe, and recession risk is still quite low. And so, yes, there's going to be shocks, and that may lead to heightened uncertainty and a little bit of instability with regards to sentiment from time to time. But when you sort of look through any of these exogenous shocks and what the sort of underlying macro conditions are telling you, it still is suggestive of an environment that is conducive for further price appreciation.
So when you talk about that price appreciation in equities, I mean, we've also seen appreciation in the Treasury market as well. Even on a day like today when yields are a little bit up, it's only up modestly on a day where you would think you would see a little bit more of a sell-off given sort of this record run we're having. What is it exactly that people are buying in the Treasury market? Are they buying Treasuries as a hedge, or are they buying it because of that price appreciation?
I think it's a little bit of both. I think, firstly, when you're owning a large, having a large equity allocation in your portfolio, owning Treasuries is a good offset or a good diversifier of risk. Stock-bond correlation on a rolling 3-month basis is still negative, so it does complement a equity position in portfolios. So that's first. I think the second thing, and importantly, is that the Fed is still buying. Global central banks are still providing liquidity to the market, and that has created very easy financial conditions. And the Fed has also told you, as they reiterated again earlier today with the FOMC minutes, that they are thinking that accommodative policy is going to last for a long time. And so the market is keyed into that. And as a result, that's telling you that it is still an environment where you're not expecting a significant sell-off in yields.